Welcome to the Deep Dive. Today, we're taking a really interesting look under the hood of United States Steel, ticker symbol X.
Yeah, X.
We've got their latest 10K filing and, well, some pretty sharp strategic analysis on our desk. Our goal here is to get past the headlines, get a clear picture of where this cornerstone of American industry really stands.
And where it might be headed.
Exactly. For the company, and, of course, for investors looking at the stock.
Absolutely. Look, whether you're actually trading X or maybe you just have a general interest in U.S. manufacturing business strategy, U.S. Steel right now, it's a compelling story.
It really is.
So we're going to dig into their financial health, what those numbers really tell us. We'll look at the big strategic pivots they're making, where the growth might come from, and how their sort of underlying strengths measure up.
And hanging over all of this.
And of course, all of this is happening against the, let's say, very fluid situation with that proposed merger, the Nippon Steel deal.
Okay, let's kick things off by really trying to understand the financial landscape.
Good place to start.
When we compare their 2024 performance to 2023, the top line, the revenue, it tells a pretty direct story, doesn't it?
It does.
Net sales, what, $15.64 billion in 2024? That's a noticeable drop from $18.05 billion the year before.
Yeah, quite a dip.
So what were the key drivers behind that decrease? What did the 10K say?
Well, the filing points to a couple things, mainly lower sales volumes and softer average selling prices, pretty much across most of their business segments.
Yeah.
If you drill down into those segments, flat rolled, that's their biggest piece, right?
Yeah.
Sales there were down about 11%.
Right.
The mini mill segment saw a 7% dip. Their European operations, USSE, down 15%. And then tubular, that one relies heavily on the energy sector.
Yeah.
That saw the biggest decline, a really substantial 37% drop in sales.
Oh, yeah.
So that really signals some potential headwinds in some key markets for them.
And that kind of slide in sales, it must have put pressure on their profitability too, right? How did the earnings look?
Oh, it certainly did, yeah. Total segment EBITDA, which gives us a pretty good view of their operating profitability that decreased quite a bit.
How much?
Went from $2.14 billion in 2023 down to $1.37 billion in 2024. And the EBITDA performance by segment, it pretty much mirrors those sales trends we just talked about.
Yeah.
Flat rolled EBITDA down 9%. Mini mill took a larger hit, down 39%.
39, wow.
Yeah. USC saw a 28% reduction, and tubular's EBITDA, it plummeted, down a dramatic 79%.
79%.
Yeah. So their overall earnings before interest and income taxes, EBIT, also followed that same downward path.
So just a tougher year financially, pretty much across the board, it seems.
Seems that way.
What about the actual amount of steel they shipped? Were volumes down significantly too?
Yes. Their total steel shipments dropped by about 8.4% overall. Most segments shipped less volume.
Okay.
Although, one interesting point, while tubular revenue was way down, like we said, their shipment volumes were roughly flat year over year.
Huh. So that really points to price pressure.
Exactly. It really underscores the significant price pressure they faced in that specific market. And we also saw average realized steel prices per ton decline in most segments, again, with tubular showing that steepest drop, nearly 40%.
Okay. Now, looking through the details, one thing that jumped out at me was the level of ongoing investment. Capital expenditures, CapEx, in 2024 were still pretty high, right? $2.287 billion.
Yeah, that's a big number.
Where was that money going?
Well, a really significant chunk of that $1.641 billion, to be precise, that was directed straight into their mini mill segment.
Okay.
This includes, the continued build out of the Big River Steel 2 facility down in Arkansas. That's a key part of their whole strategic move towards electric arc furnace or EAF technology.
Right, EAFs.
We also saw capital spending in flat rolled and USSC, but, at lower levels.
And for investors, what about looking ahead?
Yeah, it's worth noting for investors that the company expects a pretty significant decrease in CapEx in 2025. They're guiding down to around $1 billion.
Okay. So these big projects are wrapping up.
Seems like it, as these major projects come online. And that could definitely have implications for their free cash flow going forward. Something to watch.
Definitely. And just rounding out the financials, in terms of their resilience, what's their current liquidity situation look like? And how much debt are they carrying?
Okay, so end of 2024, they reported total liquidity of about $3.6 billion. That includes cash they have plus available credit lines.
Okay, decent buffer.
Yeah. Their long-term debt stands at approximately $4.1 billion.
Hmm.
So, they do have a notable debt burden, but they also maintain like you said, a decent level of readily available capital. For investors, it's always that balancing act, assessing those figures.
Okay, so financially, a challenging year, maybe a bit bruised, but with some very deliberate, large-scale investments happening.
Yeah.
Let's pivot then to that best-for-all strategy you mentioned earlier. It sounds like they're not just, tweaking things around the edges. This seems more like a fundamental shift in how they operate.
Precisely. Yeah, the best for all strategy, it really has these 4 core components that they see as their engines for future growth.
Okay.
The first one, as we've kind of already touched on with that heavy CapEx.
The mini mills.
Exactly. The substantial investment in mini mills and the finishing capabilities that go with them. And this isn't just about adding more production capacity. It's really a strategic move towards those EAFs.
Electric arc furnaces.
Right. They generally have a lower carbon footprint, which is important today. And maybe more importantly, they allow for the production of higher margin specialized steels. Things like advanced high-strength steel, AHSS for the auto sector, and electrical steels.
Interesting.
The big river steel facilities are absolutely central to this transformation. It's really a bet on where the higher value lies in the future steel market.
And this move towards EAFs, it also ties into the second pillar of their strategy, right? Leveraging their low-cost iron ore advantage. How does that fit with a scrap-based furnace?
Yeah, it seems counterintuitive at first, but it does, indirectly. They're investing in facilities like a DR-grade pellet facility and a new pig iron machine at their Gary works.
Okay, what do those do?
They produce high-purity iron feedstock, and that feedstock can be used in the EAFs alongside scrap metal to create these higher-grade steels.
Oh, okay.
So by using their own iron ore reserves to make this feedstock, they aim to, control costs and ensure a reliable supply of this crucial input. It gives them a potential edge over competitors who have to rely solely on the scrap market, which can be pretty volatile price-wise.
Gotcha. Okay, the third pillar is described as optimizing their operational footprint. That sounds a bit like strategic shrinking in some ways.
That's a pretty fair interpretation, yeah. They are strategically idling or in some cases permanently closing older, less competitive integrated facilities.
Where have we seen that?
We've seen it happen at parts of their Great Lakes Works, Granite City Works, UPI out west, and even some tin operations at Gary Works.
So the goal is efficiency.
Exactly. The overarching goal is to become more efficient, focus their resources on their most competitive assets. Their internal mantra, apparently, is to become better, not bigger.
Better, not bigger.
Which signals, a clear focus on profitability over just sheer volume.
Makes sense.
Yeah.
And the fourth key pillar is about focusing on specific, higher margin markets. Which sectors are they really prioritizing to drive that profitability?
They've identified several key sectors. Automotive is a big one, construction, consumer goods, electrical think transformers, motors, and energy.
Right.
The core idea here is really to move beyond selling primarily, basic commodity-grade steel. Instead, they want to concentrate on differentiated products, innovative solutions tailored to those specific industries.
And closer customer ties.
And building stronger, more collaborative relationships with customers in those more lucrative segments.
Yeah.
This often involves developing specialized steel grades with very specific properties.
Right. We should also probably touch briefly on their stated commitment to environmental stewardship. It's mentioned within the context of their overall strategy. How does that factor in?
Yeah, they definitely highlight it. They have publicly stated goals for reducing their greenhouse gas emissions, and they're developing newer, sort of greener product lines under brands like Verticax and Induex. Aimed at customers who are increasingly focused on the environmental impact of their supply chain, their materials.
But that comes with costs.
Oh, absolutely. It's important to recognize that these efforts, they come with their own set of costs. And the company also operates within a pretty complex and, frankly, increasingly stringent regulatory landscape when it comes to environmental issues. It's not simple.
No, definitely not. No. Okay. We absolutely cannot talk about U.S. Steel without addressing what is clearly a massive factor influencing their future right now.
The elephant in the room.
The pending merger with Nippon Steel. Their own filings highlight this as a significant risk. Can you elaborate a bit on the current state of play there and the uncertainties involved?
Absolutely. Yeah, the proposed acquisition by Nippon Steel, or NSC, it's currently really hanging in the balance.
Shareholders approved it, though.
U.S. Steel shareholders did approve the deal, yes. But it has faced considerable regulatory scrutiny, particularly from CFI-US, the Committee on Foreign Investment in the United States.
They look at national security concerns.
Exactly. They review mergers for potential national security issues. And on top of that, the president has publicly voiced opposition to the merger.
Right.
Now, an extension for the review has been granted, I believe, until June 18th, 2025. But the ultimate outcome, it remains highly uncertain. Very uncertain.
Yeah.
And this just creates a significant cloud of ambiguity, for the company, for its employees, and certainly for its investors.
So, playing devil's advocate. If this merger doesn't ultimately go through, what are some of the potential negative consequences for U.S. Steel? What happens then?
The potential downsides are pretty multifaceted. You'd likely see an immediate, probably negative impact on their stock price.
Sure.
Operationally, you have to think the management team has undoubtedly dedicated significant time, resources, attention to planning for this integration.
Right. A lot of effort.
A huge amount. And a failed merger could lead to a period of, strategic reevaluation, maybe some instability. Employee morale could definitely be affected. And their relationships with both customers and suppliers might be strained just due to all the uncertainty and the change in direction.
And the potential benefits lost.
Yeah, moreover, the potential for significant capital investment and maybe technological expertise that Nippon Steel is expected to bring, they might not materialize. And that could potentially hinder their own strategic transformation that we've been talking about.
Plus, there are lawsuits. Right.
Plus, the ongoing lawsuits related to the merger just add another layer of complexity and potential cost. It's messy.
Yeah, sounds like it. Beyond the merger specifically, what are some of the other key challenges and risks that U.S. Steel faces just operating in the broader market?
Well, the steel industry itself is inherently cyclical, right? It's heavily influenced by macroeconomic conditions.
Like what?
Things like economic downturns, inflation, rising interest rates, geopolitical events. Think about the ongoing war in Ukraine. All those things can significantly impact demand for steel and pricing.
Okay.
They also face these persistent challenges from global overcapacity in steel production. There's just too much steel-making capacity worldwide. And the related issue of unfairly traded imports, even with existing tariffs and trade measures in place.
Pause.
Then there's the volatility in the cost and availability of key raw materials, things like iron ore, coal, scrap metal, and energy prices, natural gas. Those can swing wildly and are major risks they have to constantly navigate.
And competition.
Oh, yeah. Additionally, they face competition, not just from other steelmakers, but from alternative materials like aluminum and plastics, especially in sectors like automotive.
Right.
Plus, they have significant fixed costs, things associated with retiree benefits, ongoing CapEx needs. They carry, as we mentioned, a notable amount of debt. They operate in an increasingly stringent regulatory environmental rules, safety regs, ESG pressures.
Labor.
And they have a large unionized workforce, which brings its own set of labor relations considerations. So yeah, it's a pretty complex risk profile all around.
It certainly sounds like it.
Oh.
So, okay, considering all these factors, the strategy shifts, the risks, the market dynamics, how do U.S. Steel's fundamental competitive advantages actually stack up? We've looked at their business through the lens of Hamilton-Helmer's 7 Powers framework. It's a way to assess durable advantages.
Right, the 7 Powers. It's a useful framework.
Let's walk through how U.S. Steel fares in each of those areas. Maybe start with scale economies.
Okay, scale economies. Here, I think we'd give U.S. Steel a relatively strong rating, maybe an 8 out of 10.
8. Okay. Why so high?
Well, as a large, historically integrated steel producer, they inherently benefit from economies of scale. High-volume production, buying raw materials in bulk, distribution, that all helps.
And the new mills.
And their significant investments in modern, large-scale mini-mills further enhance this advantage. This scale lets them spread their substantial fixed costs over a larger output, which potentially leads to lower per-unit costs compared to smaller players.
Okay, makes sense. Next up is network economies. This one typically doesn't apply much to basic industrial goods, does it?
That's exactly right. We'd rate this a 1, maybe a 0 even.
Okay, a 1.
Network economies, where the value of a product or service increases the more people use it, that's generally not a big factor in the market for commodity-like industrial goods like basic steel. Customer value isn't really directly tied to how many other customers U.S. Steel has.
Right. What about counter-positioning? This is where a company adopts a sort of superior new business model that incumbents can't or won't copy easily. How does U.S. Steel measure up there?
This is interesting. We'd probably give this a 2, maybe a low score.
Only a 2. Why?
Because historically, U.S. Steel, as the traditional integrated steelmaker, was actually the incumbent being counterpositioned, right, by the more flexible, often lower-cost mini-mill operators using EAF technology like Nucor.
Ah, okay. They were the ones being disrupted.
Exactly. Now, while U.S. Steel has made these significant investments in EAFs themselves, which is a major shift, they don't currently possess a fundamentally new or unique strategic position that their established mini-mill competitors would be significantly disadvantaged by or unwilling to adopt themselves.
So they're catching up, not creating something totally new.
Their current strategy feels more like a convergence towards the prevailing model, rather than creating a truly new, unreplicable position, hence the low score.
Got it. Moving on to switching costs. How difficult or costly is it for U.S. Steel's customers to just switch over to a competitor?
We'd rate switching costs maybe a 5, kind of middle of the road.
Okay, why a 5?
Well, for the more standardized, commodity-grade steel products, the barriers to switching suppliers are relatively low. Price and availability often rule. But for the specialized, high-specification grades of steel, the ones that require specific certifications, performance characteristics, maybe unique alloys, the process for a customer, say an automaker, to qualify a new supplier for that specific grade can be time-consuming, expensive, and involve some technical risk.
Okay, so that creates stickiness.
Exactly. It creates moderate switching costs for U.S. Steel in those niche, higher-value areas. Plus, the existence of long-term contracts with certain large customers also adds a degree of inertia to those relationships.
Right. Branding is always an interesting one for these old-line industrial companies.
Right.
Where does U.S. Steel stand on brand power?
We'd give branding maybe a 4.
Only a 4. It's a famous name.
It is. U.S. Steel has a long, storied history, no doubt. And the made in USA aspect that can resonate with some buyers, maybe provide a slight edge sometimes.
But it's not like buying sneakers?
Exactly. In the industrial steel market, purchasing decisions are primarily driven by factors like, is the product quality consistent? Is the supply reliable? Does it meet the exact specifications? And, of course, price.
Reliability and quality trump brand.
Pretty much. It's not like a strong consumer-style brand preference that commands a significant price premium. So while brand recognition exists, it's probably not a dominant competitive power in this sector.
Okay. Now, here's an area where U.S. Steel appears to have a more tangible advantage. Cornered resource.
Absolutely. This one's strong. We'd rate this a 7.
A 7. What's the resource?
There's significant ownership of high-quality iron ore reserves. This represents a crucial potential cost advantage, particularly for the remaining integrated steelmaking operations, and it provides a secure source of a key raw material.
How does that help versus competitors?
Well, competitors who are reliant on purchasing iron ore on the open market are subject to global price fluctuations and potential supply risks that U.S. Steel can largely mitigate because they own the mines. It's a significant and pretty defensible asset.
Gotcha. And finally, process power. This is about having uniquely effective, hard-to-copy ways of doing things. How effectively do they operate their complex steelmaking processes?
We'd rate process power a 5, again, sort of mid-range.
Why? They've been doing this a long time.
They have. As a long-standing, large-scale operator, U.S. Steel has undoubtedly accumulated a deep reservoir of operational knowledge, expertise in steelmaking, the ability to manage complex integrated production processes across different types of facilities. That's all true.
Right.
However, demonstrating that their specific processes are uniquely superior and consistently difficult for other sophisticated global steel producers like ArcelorMittal or Piosago or even Nucor to replicate. That's challenging in such a mature, globally competitive industry.
So they're good, but maybe not uniquely protected good.
Right. While they certainly have know-how and operational depth, proving a truly exceptional and protected process advantage is less clear.
Okay, so to try and bring this all together, this deep dive really shows us a U.S. Steel in the midst of a major strategic evolution, doesn't it?
Absolutely. They're heavily investing in this shift towards a more focused, potentially lower carbon production model, really centered around that mini-mill technology.
And we've seen the tangible financial impact of this transition already in their recent results, right? Lower sales, lower earnings.
Yep, but also that significant capital allocation, that heavy spending towards these strategic priorities like Big River Steel 2. For investors, understanding this investment cycle is absolutely crucial. Where are they in that spend? When does the return come?
And we just cannot overlook the substantial risks and uncertainties that are looming.
Hmm.
Most notably, that unresolved status of the Nippon Steel merger
It's huge.
and just the inherent volatility that comes with operating in the cyclical steel industry.
Yeah,
These are key factors anyone following the stock just has to keep front and center.
totally agree. And our quick run through the seven powers framework, it kind of highlights their fundamental strengths, areas like scale economies, and that really valuable cornered resource in iron ore. But it also points to areas where achieving a truly durable, protected, competitive edge remains an ongoing challenge for them. Areas like counterpositioning or maybe process power.
So wrapping this up, here's a final thought for you, the listener, to consider. Given these ambitious strategic shifts underway at U.S. Steel, and the considerable uncertainty swirling around that potential Nippon Steel acquisition,
Yeah.
what do you believe will be the single most critical factor determining U.S. Steel's long-term success? What's going to dictate their ability to deliver value to shareholders in this constantly evolving, really tough global steel market?
Yeah, what's the linchpin?
It's a complex picture, no doubt, a lot at stake. Thanks for diving deep with us today.